Good morning, Earthlings. You're at Real Turkey channel, and I'm your presenter, Atilla Yaşalara. Today, we're going to talk about the Fed monetary policy and how negatively it impacts Turkey and a lot of emerging markets or developing nations. A few definitions to get the ball rolling might be useful here. First of all, Fed, or Federal Reserve Board, is the central bank of the United States, and monetary tightening means it is going to raise interest rates successively, not only once, but probably through the course of the next 2 years. In addition to that, monetary tightening also involves a secondary procedure called taper or balance sheet reduction, which means essentially that American Central Bank Fed will be selling bonds from its balance sheet and buying dollars from the market. So it will also actively shrink the money supply. Now, the final definition is that the American federal interest rate serves as the pillar, as the fundament, as the foundation of all the other interest rates in the world. That applies to the American consumer who may wish to take out a mortgage loan or a car loan. That also applies to the Indian banker, which is going to borrow abroad to finance projects at home. Essentially, all the interest rates anywhere in the world paid are a multiple of the Fed policy rate. So this is the point probably to digress towards Turkey, because when Fed raises interest rates, with a few exceptions, all the other countries and banks have to follow suit. Now, Turkey obviously is going to be affected more than other emerging markets simply because we are a credit-dependent country. That means we are hooked to foreign borrowing. Turkish economy cannot survive unless we continually borrow from global commercial banks or through bond issues from fund managers. And we also have to roll over or refinance all of our maturing loans. Now, not every country is in this position. Some of the countries carry very heavy dollar debt loads, but they have a current account surplus, which means they have a surplus of dollars coming into their markets, so it's easier for them to finance the debt. Some others don't carry much debt, such as Russia, or have very valuable commodities to sell. Again, Russia, energy and metals, Brazil, agriculture, Argentine, agriculture, China, basic manufacturers, South Africa, gold, etc., etc. Now, Turkey is in this cross-section of countries which is going to be impacted worse from Fed monetary tightening, in the sense that, A, we have a current account deficit. That is, even without the Fed, we are sending more hard currency abroad than we take in through financial investments, through the sale of our tourism services, or through our exports. In other words, our imports are bigger than our exports. In addition to that, we are heavily indebted. Roughly, our annual need to roll over our maturing foreign debt is something like 30% of our national income, which is, I think, the second or third highest ratio in emerging markets. And most of our debt is short-term maturity, which means when Fed raises interest rates, most of our debt is immediately impacted in the sense that we have to borrow it at a higher interest rates. So as a result of that, Turkey is going to be highly sensitive to what Fed does in the next 2 years. Then we have to ask the question, what will Fed do in the next 2 years? Obviously, Fed is data dependent, which means it shares its monetary tightening plans with the general public, with the proviso that if economic conditions or geopolitical conditions changes, it may also change its game plan. Ceteris paribus, which means all else being held constant, Fed is going to raise its interest rates by a total of 200 basis points or 2 percentage points, or even 2.5 percentage points by the end of 2022. it's not exactly clear how much it's going to reduce its balance sheet, but one number mentioned by Fitch rating agency is roughly 2.5 billion out of $9 billion. Now, how do these balance sheet reductions add to the burden of higher interest rates? A simple calculation is that every $200 billion reduction in the Fed balance sheet serves like a 25 basis point rate hike. So, there are roughly 10 more basis rate hikes, 10 more 25 basis point rate hikes. In other words, I'm not very interested in numbers. I'm interested more in trends and developments. At the end of 2022, everybody will pay significantly more than today to borrow for any reason. B, bond interest rates are going to be higher. 3, riskier borrowers will be shut out of the market. In other words, if you're an American citizen, if you have a perfect credit score, Fed tightening is going to impact you moderately. If you are like me, which have terrible credit score, or if you live in Turkey, obviously you will have difficulty getting out new loans or issuing new bonds. So it's a severe problem. It affects all of the developing nations or emerging markets equally, in the sense that American fund managers are going to invest less into the bonds of emerging markets and more into American treasury bonds and corporate bonds. In other words, money will be sucked away from the countries like Turkey, which need it desperately, to the United States for the treasury to be able to finance the national debt and for banks to be able to lend to businesses and individuals. So that's one general problem. In case of Turkey, we may not be able to afford higher interest rates. Currently, an average Turkish bank pays roughly 300 basis points or 3% to borrow in dollar terms abroad for 1 year maturity. Next year, that rate may be 6%. If you look at it in terms of percentages, in 1 year, the rate of interest the average Turkish bank will have to pay to borrow from abroad will increase by 100%. And of course, since Turkish banks use these dollar loans at home to finance businesses or consumption loans, Turkish loan rates will increase as well. This simply means Fed will not only cause a credit shortage in Turkey, but also it will make credit more expensive. And you know what happens when credit becomes more expensive? Businesses and people who want to buy homes, cars, or other durables borrow less. And that slows down the economic growth rate. That obviously is not a huge problem in the United States because the American economy and European economy as well are growing at a very high rates. But Turkish economy's growth rate is expected to slow down from roughly 10%, the official data is not out, last year, to 3% this year. So we have a slowing economy and higher interest rates. Whereas United States has a rapid growing economy, high inflation, and Fed raising interest rates in this environment. The situations are drastically opposed, and Turkey is in a worse situation. And finally, of course, there is the danger of bank runs or deposit runs, which means that Turkish depositors will become frightened of the possibility that their dollar or euro deposits are not safe in the banks simply because banks cannot borrow to pay off for these deposits in sufficient quantities abroad. 2, some of the money they collected through dollar deposits have been lent to Turkish companies in dollar terms, and these companies may experience difficulty paying back those loans. So banks possibly will have less dollar liquidity in the future, which as a Turkish saver would make me question whether the bank can fulfill its promise of paying me on time. I want to thank you for watching another Real Turkey channel video. Also, I want to send a special thanks to the premium Turkish economy channel called Mesele Economy for lending me their excellent studio and their production services. Hope you stay well. This is Atilla Yaşılara saying goodbye from Istanbul.